If you're like me, you're probably sick of hearing about coronavirus all the time. You're probably sick of listening to podcasts about coronavirus all the time. So in today's episode of the Michael Yardney podcast, it's not going to be about the coronavirus. Oops, I've actually already said coronavirus 3 times. Actually, that's the 4th time now. Hey, but the show's not going to be about it. Today I'm going to teach you about wealth accelerators. And if you don't know what they are, you're going to at the end of the show, because that's what wealthy people use to become, wealthy. And then I'm going to have a chat with Pete Wargent about how Australians aren't moving as much anymore, not changing houses often. Now, we recorded that particular part of the show before the coronavirus epidemic locked us up, so I know we're not moving much at all at the moment, but it's a bigger picture demographic trend that Pete and I discuss. So, welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
Do you understand what a wealth accelerator is? Well, maybe you should. I'll explain it to you this way. A couple of weeks ago, I was having a chat with Jared, who's one of the mentorees in my mentorship program, and he said to me, Michael, why do the rich keep getting richer? I've read your books, I understand that they've got rich habits, but shed some light on what it is that they actually do. So I explained to him that the rich use wealth accelerators. What do you mean by that? He said. So I thought I'd share this lesson with you too today. Now, you've probably heard the expression that money begets money. Maybe you've even wondered why it's easier for people who already got plenty of money to make more of it. Or maybe you've wondered why making a second or third million is so much easier than making a first million. Well, here's why. Strategic property investors who've built a true property investment business grow their wealth faster by using a number of what I call wealth accelerators that leverage their returns. So let's look at them. The first one is one that you're aware of, you'd know about. They use other people's money. It's something you're very familiar with. But one of the big differences between the rich and the average Australian, now again, this is not a judge of people. So if I say rich or poor, this isn't again a judge of people, but most people listening to this podcast want to get further financially, want to be smarter with money, want to be more successful, want to have more property. So please, no judgments. Let's just discuss why the rich keep getting richer. And one of the big differences between how the rich and the average Australian go about building their wealth is how they invest. But not their own money, how they leverage and use other people's money. You see, the average Australian rarely uses leverage in a strategic way because they're afraid of taking on debt. They've been taught, get a good education, get a good job, buy a house, pay it off, and then maybe once they've paid it off, then they may start investing. And if they do build any wealth, they do it mostly by scrimping and saving and using anything that's left over, slowly building up their nest egg. On the other hand, the wealthy, they've mastered the use of using money that they don't have, to build their wealth. They've used borrowed money to magnify their investment activities, and they enjoy accelerated returns by borrowing and leveraging against owning the right sort of assets, income-producing assets, but capital growth assets. So they need properties that grow at above average rates of return, which we've discussed often in this podcast. So the rich are more financially fluent, and since they've got a more sophisticated understanding of how to use debt, they're able to use that to build their wealth to the next level. But I want to discuss with you 7 accelerators, and another one is that they use other people's time. Successful property investors make the most of their time by leveraging other people's time. While many beginning investors, they waste time, they waste energy, they waste effort trying to do everything themselves, successful investors put their time to its highest and best use. In fact, they know if they're the smartest person in their team, they're in trouble. I know lots of beginning investors think that they're saving money by doing their own research, by doing their own house hunting, by doing their own property negotiation. However, their lack of experience usually means they get a secondary result and they pay a huge learning fee, much more than the fee would be to get a consultant. They pay a huge learning fee to the market by paying too much for their properties, or by buying the wrong property, or by missing out on significant future capital growth. So it's a huge cost. Other beginning investors, of course, try and collect the rents themselves, undertake the maintenance themselves. It doesn't work that way. Successful investors outsource these tasks. They outsource them to property managers or other people. Instead, they use their valuable time to learn more, to develop relationships, and to find more deals. Now, the third wealth accelerator is that the rich know how to legally use the tax laws. Believe it or not, the tax laws were written to benefit business owners. So if you run your own property investment business, you're able to accelerate your wealth by taking advantage of what I love calling tax loopholes. See, essentially, as an employee, your cash flow works a bit like this. You earn money, you pay tax, and you get to spend what's left over. However, as a business owner, your cash flow position, your cash flow pattern is actually very different. You earn money, then you can spend it on legitimate expenses associated with running your business, with earning income, and then you pay tax on what's left over. So, as you can see, this is virtually the opposite of what employees do who get taxed, and that makes a significant difference to your cash flow because you can spend money on legitimate business expenses before paying tax, before the government gets its share. It leaves you more money for yourself. When you become aware of these tax laws and the deductions, then you can maximise your income and legally minimise your tax. The fourth wealth accelerator that the wealthy use is correct ownership structures. The rich know how to set themselves up. Well, they get the right consultants to help set themselves up. So if you choose the right ownership structure to run your property investment business or your professional practice or your business in, it accelerates your wealth. Successful investors actually own nothing in their own name or very little in their own names, but control everything in structures such as companies and trusts. And they've found that the correct ownership structures also give them a form of asset protection, and they're very useful for estate planning to be able to pass their wealth on to future generations. Okay, I'm going through with you 7 wealth accelerators that the rich use to help them get richer, and I hope you're getting some benefit from this, because the 5th one is that they have a good team around them. It's their network that's a wealth accelerator. They realise they don't have to be an expert in every field if they develop a good network, including a smart finance broker, a good solicitor, a property-savvy accountant, a knowledgeable property investment strategist. And in fact, we believe you need more than a property investment strategist and a good buyer's agent, and that's why the team at Metropole have a much more holistic approach, and we project manage our clients' wealth by coordinating all these, but first of all putting a plan to our client. Look, as I've often said, if you're the smartest person in your team, you're in trouble. So successful investors also have mentors. They belong to a mastermind group of like-minded people who encourage each other, who help each other, who push each other forward. Having a network like this around you helps you leverage off other people's expertise. Your network of relationships is critical to growing your wealth, not just for what they know themselves, but it's also for other people that they know. You've probably heard me say it before. It's not who you know that matters. It's who you knows that matters. And I'm not stuttering. And that's why it really is important to get a good team around you. I'm going to go through a couple more wealth accelerators in a moment, but maybe it's opportune for me to say, if you want to grow your wealth to the next level, why not allow my team at Metropole to help you? Because we actually have no properties for sale, but we actually do have a great network of experts that it's taken us over 20 years to build, and you're going to have access to them. Why try and do it on your own when you could use our team to put a strategic plan together for you. We've got a whole range of service from wealth advisory to property strategy to buyer's agency, financial planning, property management, renovations, development. You may want to use some of those services or all of those services. Why not go to metropole.com.au or call us on 1300 Metropole and allow my team to be part of your network so that you can use this as a significant wealth accelerator for you. Now, back to the other wealth accelerators that successful people use. It's their mindset. That's another one. And a great leverage point for the wealthy to help the rich get richer is the way they think. They just think differently to the average person. On the other hand, the not so rich, well, they think quite in a different way. Look, to put it simply, your reality is what you think is real, which means your perception, what you think is your reality. Now, I found the poor say things like, I can't afford that, I can't do that, I already know that, oh, that's wrong. I tried that once, but it didn't work, so I'm not going to do it again. No, that's impossible. The fact is, what stops most people from becoming successful isn't what they don't know. It's what they think they know, which isn't actually so. So if you want to become truly wealthy, you're going to need to open your mind to a whole range of new ideas. You're going to need to develop new skills. You're going to need to take on a greater set of possibilities, things that are already better than your current abilities. And I commend you. You're listening to this podcast and you know that only half the time do I speak about property. A large portion of these chats I have with you are about mindset because that's the big leverage point, one of the wealth accelerators that the wealthy use. So while all the other people are telling you about the next hotspot and all these things, I hope you're getting benefit from me sharing my many years of experience. See, it's just too hard to become wealthy from the perception, or I guess the reality, because as I said, your thoughts and your perceptions become your reality. It's just too hard to become wealthy from the perception that's based on lack, that's based on limitations. And that's why the average Australian will never become wealthy. Now, we're going through the wealth accelerators, and the last one is that the wealthy, the rich, own the right assets. So when you look at the various rich lists, you'll find that most wealthy people have either made their money through property, or if they haven't, they may have made it through business or other ventures. They've invested the bulk of their money in real estate. Of course, many Australians have accumulated the wealth through businesses, through shares, but they've found, well, most of them have found that by investing in residential real estate, that's accelerated their wealth. It's actually stabilised their wealth. So when the share market's goes up and down and the value of their business goes up and down, property is a much more stable asset. But the more important thing is it allows them to leverage all the other factors that I've just mentioned to you to fast track their wealth. So choosing the right property, owning it in the right structure, financing it correctly so you can use more of other people's money, using the tax laws to minimise your tax, understanding how the laws protect your assets, that all vastly accelerates your wealth creation. Now, here's another interesting thing about these wealth accelerators. If you combine two or more of them, that just doesn't speed up the growth of your property investment business incrementally. It helps grow it by quantum leaps. So now that you understand wealth acceleration secrets, now that you understand what the rich are doing, which of these are you going to use? Now, there'll be a list of them in the show notes, but remember, one of them is to have the right team around you. Interestingly, all the successful people I know have consultants, pay consultants, are prepared to because they see it as an investment. All the poor people I know get advice for free from project marketers, from real estate agents on the internet. There's a difference in their results, isn't there? Remember, of the 2.1 million property investors in Australia, 1.9 or just over 1.9 million of them own one or two properties. Only 21,000 own six or more properties. If you want to be in that group of people who own six or more properties, use these wealth accelerators to help you get to that level. By the way, if you'd like me to be part of your journey, go to metropole.com.au and leave your details, and we'd love to have a chat with you. And remember, we have no properties for sale, so we'll give you some independent advice. metropole.com.au or 1300 Metropole. Well, you've often heard me say that demographics drives our property markets. How we live, where we want to live, how many of us there are, that makes a big difference. And today I'd like to have a chat with my regular guest, Pete Wargent, one of Australia's leading property, economic and financial commentators, about how we live, where we are living and how long we tend to stay in the same premises. So welcome, Pete.
Pleasure, Michael. Always great to be here.
Now, in the old days, when I first introduced you, I actually called you one of Australia's young, upcoming leading commentators. Look where you've come since we first met well over a decade ago. I can't remember how long it's been now.
Yeah, especially with two toddlers these days, I'm feeling my age.
So we both understand the importance of demographics in driving property trends, but I know that some of your research has shown that we tend to be staying in the same premises longer nowadays.
Yeah, so the latest available figures actually show that especially homeowners are now hanging on to their properties for longer than they used to. So for houses, on average, about 11 years, and for apartments, about 10 years. So it's a surprising trend because it often feels like, especially younger people these days, are changing jobs more quickly and moving around. But actually for home ownership, people are staying put and hanging on to properties much longer than they used to. So there's some underlying drivers of that which would be worth exploring.
Well, as property investors, we tend to think about tenants and capital growth and rents and things like that. But we've got to remember that 70% of properties are owned by owner-occupiers. And if you're wanting to buy an investment-grade property, you similarly should be buying something that would be appealing to them. So, yeah, let's look into this a bit further. Why are people staying put for longer, Pete?
Well, I think it's quite clear. The longest tenure is for houses in Sydney and Melbourne. So to me, that says it's the discouraging cost of actually buying, selling and moving that really discourages people. I suppose, especially in the stronger performing markets, there may also be a fear that if you sell your home and you take some time to get back in, you might actually fall off the property ladder. So people have a tendency to stay put, renovate. And the other thing as well is that as the population ages and people are actually living now much longer than they used to. So if you live to 65, you might expect on average to live nearly 20 years in retirement, and some people will live much longer. So all of these things are just dragging out the period of home ownership.
Well, baby boomers aren't doing what people thought they were going to do. Remember, years ago, it made a sense at the time. People thought they were going to go to tree change, to sea change. The generation before the current baby boomers, many of them moved into retirement villages. That's not what baby boomers are doing. They're staying in their big homes, despite having lots of empty bedrooms. And I think you're right. An element of it is that it's too expensive to move. I know as baby boomers, many thought, oh, when the time comes, I'll sell my home, I'll downsize into an apartment, a villa unit, a townhouse nearby, and I'll have money left over. But there isn't much change left over when you do that, is it, Pete?
No, and I think as well, the trend is maybe partly due to a lack of suitable medium density choices. So Michael Matusik, who you have on often, would surely say the same thing, is that we've built a lot of new small apartments, a lot of them for investors. There's loads of high-rise stock gone up. But in terms of suitable medium density choices for retirees, there are some retirement living places, especially up here where I live at Noosa. But overall, a lot of people, they just like the familiarity of staying put. And a lot of people have just chosen to age in place. So that's probably something that policymakers and developers need to address. But at the moment, it's not really working.
Sure. So I've found that most baby boomers still want to go to the same doctor, the same dentist, the same hairdresser. They want to be near their family. Similarly, they want a big house where when the kids come over, mum can hold court and have lots of people over for lunch, for dinner, whatever it is. And so baby boomers are remaining in the same place. I think the other thing is they're not leaving the workforce as quickly as they used to. In the old days, I guess a lot of us doing manual labour in the old days, not me, but people were, they would have to retire earlier. But now with more sedentary jobs, people seem to be able to stay in the workforce longer, Pete.
Yeah, that's right. And especially because now it's a services-based economy. 80% of employment is in the services sector. It's not necessarily the physical manufacturing jobs. So people can choose to work for longer. maybe in a part-time or contracting capacity, but there's no reason people have to retire at 50 or 60 or 70. It's a more fluid dynamic than it used to be. And why not? People are enjoying that flexibility.
Unfortunately, some people have to stay in the workforce. We've found that many retirees just don't have enough money behind them. And part of that is the fact that superannuation, compulsory superannuation, didn't come into play till the early 90s. So a lot of baby boomers don't have as long a period of self-saving for their retirement. So one area of demographics is the older people. What's happening with the other end of the demographic scale, the younger people, Pete?
Yeah, this is the really interesting thing to me, because if you talk globally, and there are lots of countries like Japan where they have a real issue with population aging. Now, in Australia, yes, we've got more baby boomers going into retirement than we ever had before, and people are living longer in retirement than before. But one thing we have had, especially through the mining boom years and now even beyond that, we've had an unprecedented surge of immigration, and that's very heavily skewed towards the 20 to 30-year-old demographic. We also take in a lot of international students, many of whom choose to stay on. So if you actually dice up, and as you know, I do this with the census every time it comes out, if you just dice up the population of Australia into a pyramid, what you'll find is that the biggest cohorts are actually aged 30 to 34 and 25 to 29. And that's a result of the very high rates of immigration that we saw through the mining boom years, and that's just continued. So yes, we've got lots of boomers, but actually we've now got this unprecedented surge of young Australians moving into the prime first home buying age brackets. So it's a real, I called this the demographic tsunami 4 or 5 years ago. People thought I was just spruiking the market or whatever, but just look at what's playing out in the population pyramid. And people say, oh, well, young people aren't buying homes like they used to. It's true, but they're still buying just a bit later than they used to. That's the thing.
Well, many are buying investments instead, aren't they? They're actually rent vesting and buying investments earlier than their parents used to.
The smart ones are, in myself included. I did buy a first home, but I was also very keen on the idea of investing, and then for various points in time renting where I live, just to keep on moving forward. And I think a lot of people tend to, we all like to think we're unique and different, but the thing with demographics is, you see this time and time again, people tend to do similar things at a similar stage in life. So yes, the first home buying age might be a few years older than it used to be, but people are still ultimately starting families, wanting to buy a first place. It might be an apartment these days instead of a house, but people are still doing what they used to do. They're cohabiting and then getting married, having kids, buying homes. So there's an unprecedented surge of demand coming in, and especially now with the first home loan deposit scheme, number of first home buyers. Everyone's saying 3 years ago, they're all gone, they're never coming back. Well, we're at 10-year highs now and rising quickly. So it just goes to show it goes in a cycle.
So while homeowners are holding on to their homes longer, I remember it was a number of years ago I read a study from the AHRIU, which was actually looking at ownership of properties by investors. And they were looking at it on behalf of tenants, but they basically showed then at the time that property investors sold up very quickly. About 50% sold up in the first 5 years of ownership. In fact, I think it was about 20% sold up in the first 2 years, because property investors were getting it wrong. They were either not financing it correctly, or they bought the wrong sort of property, or their circumstances changed. So that's at the other extreme. And that's part of the reasons some investors, let's be blunt, many investors never build the wealth that they deserve.
110%. I think of all the financial decisions I've ever taken, and I've mainly got my wife Heather to thank for this, not selling property is probably the single biggest determinant on my net worth today, because especially as a bloke, we have a tendency to think, oh, we should sell a couple, go and do a development, go and do this, that, and the other. And that's all fine, but too many people just never own quality property for long enough to benefit from the compounding capital growth. And that's what it's all about as an asset class. So yeah, sure, if you've got a dud property or it's draining cash flow, you might need to offload it. But if you don't own property for long enough, you never get to benefit from the magic of compound interest.
Now, one of the side effects, I guess, the implications of baby boomers in particular staying longer, is that the properties in the middle ring suburbs, where a lot of the baby boomers are not being used to their highest and best use. They've got big houses on largish blocks of land that today could be better used for multiple occupancy, dual occupancy, medium density. That's creating a bit of a bottleneck for where people want to live.
Yeah, sure. So now we've been through the biggest construction boom in Australia's history. And in some areas, we got overbuilt. So particularly in Sydney and Melbourne, the areas, Docklands, the CBD and so on. Sydney, places like Parramatta, Blacktown, Wentworth Point, those areas. But the overbuilding was very much of one property type, and that's the high-rise apartment sold to investors. It was initially driven by lower interest rates and an unprecedented surge of Chinese mainland buyers wanting to park money in Australian property. So there was this kind of I hate the phrase perfect storm, but that's kind of what it was. So we got overbuilt in that particular property type. But if you actually look at the type of stock that people want to live in, maybe larger apartments or, something with a point of scarcity or family appropriate dwellings, we're now heading back into a big undersupply. So we're already seeing rents rising again early 2020 in Sydney and Melbourne and Brisbane. And we're starting to go the other way now towards underbuilding, undersupply. It's harder to get finance. And especially for that type of property with the medium density stock with scarcity value, there's going to be a massive undersupply, especially where you live, actually, down in Melbourne.
Now, Pete, I know in April now, this month, this podcast's coming out, you've got a new book coming out, whether it's out yet or just about to. Just tell us quickly, how many books have you written now? You're very prolific.
I've lost track. I think this is the sixth published book. I've written a couple of others, but it's the sixth one that I've had published, and via Wilkinson Publishing, and it's called Low Rates, High Returns. And as the name implies, it's about how to invest in this new low interest rate era. So interest rates effectively at zero now in Australia. So it's a timely book, and also at the time of speaking, stock market's imploding as well. So people are just coming around to the realization that you need a different approach, or at least a calibrated approach. Now we've got record low interest rates. Cash in the bank isn't going to cut it anymore, and neither are term deposits. So you need to maximize your property and stock market strategies to take full advantage of the cycles.
Well, I'll leave a link in the show notes about how people can get that book. Similarly, we'll give a link to your great daily blog that I regularly read, because I love all the charts that you've got there and your interpretation of the world at Blogspot, and also your Pete Wargent blog at Go Next Level Wealth. And of course, you regularly write on Property Update as well. And you're the most regular guest on the Michael Yardney podcast, because I have so much fun chatting with you. Catch up with you again real soon, Pete.
Cheers, Michael. Speak soon.
Well, I told you we were going to do a whole show and not talk about coronavirus, so I hope you understand a bit more about wealth accelerators, and let's see which one of those you use to take advantage of the opportunities that will be there as the world moves on and as we get into the new normal of whatever it is. And if you want a team on your side to help you, a practical team that has a holistic view, that's not just bias agents, not just property strategists, but gives a holistic view of wealth creation, why not have a chat with my team at Metropole to help set you up to take advantage of the opportunities once the world becomes normal again? Go to metropole.com.au and find out about our services. Leave your details, have a chat with one of our strategists. Let's see what we can do to help you. Now, if you got some benefit from today's show, I'd really appreciate it if you told some other people as well, because my aim is to make as many people financially fluent as possible to help them through the more challenging times. And if you enjoyed the show that much, tell the world, as Natalie did recently on iTunes. And if I read out your review, as I'm going to Natalie, and you email me, michael@metropole.com.au, I'll give you one of my books as a way of saying thank you. Now, you can leave 1-star, 5-star review, I don't care, but I'm happy that Natalie left a 5-star review and said, Michael, thank you so much for your words of positivity, especially during this pandemic. Only 3 weeks ago, I was in a completely different frame of mind, thinking the world was crumbling down around my partner and I. Your message of don't make 30-year decisions based on the last 30 minutes of news really stuck with me and has been a reminder to me since. Thank you for sharing your wisdom. Love, Natalie. Well, Natalie, thank you so much for that kind message. And if you get back to me, michael@metropole.com.au, I look forward to gifting you one of my books. I'll be back again real soon. If you want to keep contact with me in between shows, why not follow me on social media at Michael Yardney? And I look forward to being in your ears in this podcast again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?